addition to receiving ordinary income, an individual taxpayer may also be in receipt of various forms of statutory income as part of their overall assessable income. When leaving a job, a taxpayer can receive various forms of statutory income. Malcolm is an Australian resident aged 67 who retired from his job as a computer technician with ABC Limited. Malcolm received an employment termination payment, a lump sum payment of unused annual leave accrued in the previous 2 years, and a superannuation benefit from a complying superannuation fund. Malcolm was not in receipt of any other income, nor incurred any related expenses during the tax year. So how do we determine the tax implications for Malcolm? An employment termination payment can be made up of a life benefit termination payment, a death benefit termination payment, or a genuine redundancy or early retirement scheme payment. In Malcolm's case, it is a life benefit termination payment, as he is retired after the retirement age. Only the taxable component of an ETP is subject to tax. The tax-free component can consist of either or both any invalidity segment and the pre-July 1983 segment. The taxable component is included in assessable income, but the employee is entitled to a tax offset that puts a ceiling on the tax rate that may apply. Generally, the tax rate depends on the age of the employee and the amount received, with the tax offset ensuring, as a general rule, that tax does not exceed 15% on the amount up to the ETP cap amount if the taxpayer has reached preservation age on the last day of the income year, and that tax does not exceed 30% up to the ETP cap amount if the taxpayer is below the preservation age. In all other cases, tax is payable at the top marginal rate on amounts in excess of the ETP cap. In this case, the excluded tax-free component only comprises the pre-July 1983 segment. So we need to calculate the pre-July 1983 amount so that we can work out the tax-free and taxable components. We now divide the number of pre-July 1983 days by the total days to determine the ratio attributable to pre-July 1983. We then multiply the total ETP by this ratio to work out the pre-July 1983 component. This is the tax-free component. We then subtract the pre-July 1983 component from the total ETP to determine the taxable component. To work out the tax on the taxable component, we note that Malcolm at 67 years of age has reached the preservation age, and as such, the amount up to the cap of the post-July 1983 component will be taxed at 15%. The amount over the cap will be taxed at the top marginal rate, plus any applicable levies. Part 2 of this clip will look at the other payments received by Malcolm upon his retirement.